Welcome back to the channel, everyone. Today we're going to be looking at Facebook, ticker symbol FB. We've covered Facebook's valuation before on this channel in 2020. You may not remember, but it was very near to fair value based off the DCF valuation we did even back then. Now Facebook reported full year 2020 earnings, which were amazing in my opinion and went very much under the radar in terms of getting a lift out of the stock. The stock has actually been trading sideways for the last 6 months, so another good reason why we could see a lift very soon. There's also the high interest from a lot of super investors or investing gurus as of the latest 13F filings that were released this week, and that gets me interested in diving deeper as a lot of these investors are historically right in their picks. But if I'm being completely honest, my interest in Facebook is more due to the fundamentals and fairly modest valuation considering the market which we're in. Facebook is a huge market cap already, as you can see, so we're not digging for a 10x in 5 to 10 years with this stock, and it may not be as exciting as your typical SPAC that we've been covering or a new disruptive technology company that we've covered as well that is taking the market by storm. But don't be fooled by the market cap of this company. They're growing at a very fast pace and have a long runway left for further growth. I feel like sometimes you can get caught up in some of the parabolic growth companies that are growing at, say, 100% quarter over quarter, and they're available in the market at the moment. But don't forget that consistent 20% growth is a massive achievement, and especially for a big organization such as Facebook. And 20% growth in the long term will almost always reflect in the stock price. Also, another reason why I am buying some more Facebook, I've got to say I do already own some Facebook. It's one of the only big cap tech, actually I'll tell you now, the big cap tech companies which I own are Alibaba, Facebook, and a bit of Amazon. So even if you're someone with a portfolio of these smaller cap disruptive tech stocks, it will do you some good to diversify even a little with a more defensive but growing stock such as Facebook. Don't get me wrong, I'm not a fan of diversification, I call it, but this will give you some added stability in your portfolio and keep that trigger finger happy so compounding can do its job. Everybody says they won't sell, everybody says they believe in the story of the company, but all it takes is a slip up in the product. Some of them may not even have products, and that stock could capitulate. You will not get that with a Facebook, but what you will get is some big long-term growth. Even though it is large already, it's likely it will grow at over 20% a year, and you'll probably get a 20% plus return over the next 5 years, which I'll show you in my valuation. So all in all, my take on it is you're improving your portfolio by adding a stock such as Facebook. Okay, so I think a deep dive into Facebook isn't necessary. We know what Facebook does. The majority of the revenue is made up by digital advertising, and although they have some other bets on the side, I do think advertising is going to dominate at least over 90 to 95% of the revenue going forward. But let's cover some of my areas of interest as of the latest results or 2020 results. We can discuss the growth catalysts along the way, and then we will get into my valuation for Facebook that shows that it's undervalued. So firstly, Facebook's Q4 and full year 2020 earnings. Start with revenue. So total revenue growth, 22% year over year, added 15 billion of revenue during an economic crisis, which is why I brand it a defensive stock. Net income and earnings per share, 57% and 58% growth respectively, which definitely didn't get enough coverage for me. Operating margins actually improved in the most recent quarter, way ahead of what they did last year as a full year and the full year 2020, and over quarter as well. Marginal improvement, which is very good to see. Free cash flow actually reached 9.2 billion in Q4 alone, and that is an insane number, which demonstrates just how profitable Facebook can actually be. Full year free cash flow was somewhere in the region of 23 billion, and that was with a major blip in Q2 when COVID basically temporarily wiped out the majority of the economy and a lot of Facebook's customer base. And just on a side note, here's one thing that really impresses me about Facebook. You can see here this capital expenditure tab, which Yahoo Finance has taken from their financials. And you can see it stayed around 15 billion for 3 to 4 years, which is quite remarkable. That revenue has doubled and free cash flow has doubled during this period. And it just shows you how efficient Facebook is as a business. And it possesses an ability to reinvest capital at sky-high rates, a quality nearly all long-term compounders possess. Facebook is cash rich with almost 62 billion of cash on hand. Not many companies in the world that have that amount of cash. And for a company that has such high returns on invested capital, that gets me excited. Also, they've introduced a buyback scheme they've had for a while, but they're buying back even more now, buying back billions of stock, which I always welcome, assuming they have no other high investment opportunities externally. But this company generates so much cash, 40 billion annually in cash earnings, or Ebitda, that it can't possibly deploy all of it, and it's a very good problem to have. Okay, so super investors, we will call them. As I said, Facebook is the most popular stock out of all the super investors that are listed on Dataroma. Now, these are big fund managers, as you can see here, maybe a few familiar names. And there's not going to be a whole lot of smaller cap stocks that make up the big bets because they manage billions and billions of dollars and need liquidity and things like that. So it does give us a hint, though, as to the best of the big bunch, if you like. And I think Facebook is definitely up there. And I wouldn't take this as a guarantee just because it's a guru favorite, but it's a good indicator as these investors are historically very high performance, which is why they are on here. But it's good to see the likes of David Tepper, who's a brilliant investor. Seth Klarman actually bought a whole load of Facebook in this most recent quarter, loaded up 63% or increased his position 63%. It's a big bet in the likes of David Tepper, who has it, I think, as his fourth largest holding. Some other great investors like Terry Smith, UK investor, has it one of his top 5 holdings. And the likes of Lilu and some others, we could go around all day. But anyway, it's good to see that when I was analysing Facebook, I had some impressive names on my side and buying at the current price, or price that it is around now, as you can see here. So I guess it's time to go over my DCF and look at the potential forecast for Facebook as well as the valuation. Please pause the video at any point and look at the numbers, digest the numbers, because I know there's quite a lot on here. But you can see I've got 5 years of historical results for Facebook, and they're fantastic results, averaging 37% growth on the top line. And then I'm just taking the free cash flow and EBITDA and net income margins, free cash flow as a percentage of net income like we usually do. I'm going to be using those averages in the valuation as well, and assuming that they will stick to that average over the next 5 years. And one thing I would just like to point out as we start getting deeper into the valuation, I just want to point out this earnings yield and free cash flow yield here at the moment. So we can see Facebook's currently offering us a 3.8% earnings yield. And in a world where the 10-year treasury rate is at 1.3% and even lower if you're looking outside of the US, and it doesn't look like that is going to grow anytime soon, we compare that with the likes of Facebook that's offering a 3.8% earnings yield to its shareholders, which is likely to grow at over 20% per year. Like we've covered on this channel already, it's not long before that earnings yield, if you buy today and grows at 20%, becomes a 5% and then 10% earnings yield, which in any environment, a 10% earnings yield is a fantastic investment, and it will carry on growing from there. So just wanted to point out as we get into the valuation part that in this sort of environment, when a company that's going to be growing is offering you a 3.5% plus earnings yield, it's a sign of quite good value in my opinion. Now I'll talk you through the forecast that I've done. Okay, so 20% was the consensus, or 20% plus in some areas, but I'll put the consensus analyst estimate for the next 5 years up so you can see I've actually gone below that at 17.5% to be conservative. Not that I feel Facebook can't achieve that 20% growth year over year for the next 5 years. I think it probably could, but even with a lower expected growth rate, you will still get to a fair value today. Now, EBITDA margin, or profit margins, I should say, and free cash flow as a percentage of profit have been kept at their 5-year averages, which I think they will be able to at least sustain over the next 5 years. It's possible they could get better. I mean, I know Facebook is very profitable, but as we've covered, I didn't probably dive into it as deep as I could have, but Facebook has the possibility of being even more profitable. I think about 25% of their revenue that they spend is off of R&D. If you take just the cost of revenue and then the G&A and sales and marketing, it's something silly like a 52% profit margin, bottom line profit margin. So they still have more room when growth starts to slow. But I've kept it at the long-term average. Shares outstanding have actually dropped down at 2% per year. As they've already started that process, I think we saw here, it went down from 2,956 to 288 as they introduced that share buyback program. And they've ramped it up as we saw. So decreasing it only at 2% per year, even though the 24 billion buybacks actually does decrease it even more than that. But it's a good thing for a company like Facebook to have and will definitely help their share price. It's going to help EPS and free cash flow per share grow it even faster than that 17.5% rate up there. Now, the terminal values, which is where it gets tricky because they already are quite a big company, but I've kept it near their average, which is 28 times for a PE ratio, which, as we know, is quite cheap at the moment, especially for a company growing near 20% per year. EV to EBITDA, I've gone with under 20 times. I know people like to give 25, 20 times for a tech company, but I've gone with 19 times, which somewhat matches the growth rate. And then I've averaged that out with a perpetual growth method for the terminal value as well, which comes out at about 1.5 trillion versus the 1.8 trillion and 1.4 trillion for the two multiple methods. So that averages, as we can see here, to about 1.699 trillion, which doesn't seem like a huge number, honestly, for Facebook. I know it's 760 billion or something like 770 billion at the moment, sorry, but 2021 revenue target's 100 billion. As it gets to this point, it's starting to look like Google already. So I can see them hitting $1 trillion valuation in the next sort of 2 years or even 3. And if we just focus in on the DCF, so the important part, what you wanted to see, as I said, we averaged out those 3 terminal values, and that gives us 1.6. We add back the cash, subtract the debt, which there isn't much of it. And then we get our market cap or share price target in 2025. That shouldn't say 2030, I'm sorry about that, of $650 per share. And with a discount rate of 15%, that gives us an intrinsic value of $877 billion today, or a share price of $336 per share. So by that, shows us that Facebook is currently 26% undervalued, which even with a 20% margin of safety gets us to our current stock price. So that would be over a 20% return based off of that DCF, quite a way over actually. And like I said, I've been fairly conservative, I think, in the growth. If I went with the analyst estimates of 20%, then we go up even higher. It shows that we're 38% undervalued as of today, and the share price, fair price, sorry, should be $369 per share. And even with a 20% margin of safety, the buy price would be $295 per share. Now, I'll show you the IRR calculation for Facebook, and this will give you an idea as to if we bought Facebook today and our forecast panned out, what sort of IRR return will we get annually? So our base case, which just mirrors the DCF we just looked at, is a 27% IRR, which is a fantastic return, market-beating return over 5 years. And for a defensive stock like Facebook, you're not going to see much out there with that sort of IRR potential. Bearish case, now obviously it could be worse than this. I'm not saying that Facebook has no risk at all. It does actually have some quite prevalent risks that I haven't been able to cover in much detail in this, but I'll leave some info in the description about some of my concerns maybe for Facebook. But this bearish case, it's not that bearish, but what it's saying is that growth is way under what people expect. We only manage a 10% growth rate over the next 5 years. And the PE's gone down a little bit to 20 times rather than 25 times up here. The free cash flow yield, it's selling for 5% yield as well, which is quite unlikely, but could happen. However, the profitability margins stay the same, so it's still producing a lot of free cash flow for us. We get an IRR then of 21%. So a slightly bearish case, I should probably call it, is still not looking bad at all. And then we've got our best case, which I would say is a 20% growth rate, which we looked at the possibilities for that. A 3.5% free cash flow yield, PE of 28.5 times, which sort of mirrors that yield, if you like. That gives us an IRR of 31% over the next 5 years, which is an unbelievable return. And if you ask me, I wouldn't say that the best case is unlikely to happen. I think it's actually just as likely to happen as this base case that I've shown there, but I'm trying to be fairly conservative. But so hopefully that gives you an idea as to why I am very bullish on Facebook at the moment and why I'm buying at the current price. It's a company with, I still think a very long runway for growth. It's definitely a defensive stock with a fortress balance sheet, really good fundamentals, and a huge competitive advantage in the field that it plays in. That's about it for this video, guys. Hope you enjoyed the video. Let me know what you think of Facebook and the valuation in the comments below. If you enjoyed the video, leave a like, helps the channel out greatly. Subscribe if you haven't already, and I will see you all in the next video. Good luck with all your investments.